how to maximize the cash value on a whole life insurance policy. In this video, we are going to go through step by step exactly what to do in order to truly maximize the cash value on a whole life insurance policy. This is great if you own a policy, are considering a policy, or maybe you're somewhat interested, but you really want to know the mechanics and how to set these things up for maximum cash value. Let's get into it. So, core benefits, first and foremost, on any whole life insurance policy. In respect to the cash value, if we do everything properly, safe, liquid, tax-free area to position money. This makes it so attractive. Tax-free, if we do everything properly, we're going to touch on that as well. When I have a life insurance policy, if you are going to pay any amount of money toward an insurance policy, typically what is that payment called? A premium. I pay a premium. If something bad happens with an insurance policy, a claim is then made, a benefit is made. With a life insurance policy, I have to die and then a death benefit is paid out. However, when it comes to the cash value, we can actually choose where our money goes, and it can go toward two areas. You'll see them up on the board here. One is the base premium component. I'll often refer to this as the initial insurance expense. And then second, we have what is called a PUA, stands for Paid Up Additions Rider. This is a means of accelerating the cash value immediately, and I do see a death benefit, a small death benefit, come from those payments as well. To illustrate, if I am going to pay $10,000 per year toward the base premium, you will find in respect to your cash value, right off the bat with a traditional whole life insurance policy in the first year, and often the first and second year, 0 or a very small percentage of those premium payments show up in cash value. The reason why is with a whole life insurance policy, the company is going to overcharge you, the policyholder, for the death benefit up front. This is primarily where insurance companies make their money off of premium dollars. It is also where insurance agents are most heavily compensated. So that's the base premium component. If I pay the same amount of money, $10,000 toward the PUA rider, that cash dump-in I'll refer to it as, what you'll see is approximately $10,000 show up immediately in cash value. That's money you have access to. Begins to earn the guaranteed rate. Dividends. This is the key to maximizing the cash value on a life insurance policy. When you look at big banks, corporations, wealthy individuals who optimize the cash value on these products, they're often or almost always using this rider and putting as much money as they possibly can toward this PUA component. Now, it will purchase you some additional death benefit as well. This depends on my age, gender, health, but typically, if I pay $10,000 toward the PUA component, I'll see, call it another $30,000 show up in cash value. And why I have approximately $10,000 there is that there are PUA fees. I might see day one about $9,800 or so show up. So there is a small fee initially. However, the compounding starts immediately and you'll see it pick up over time. Here's where we can build awareness. So you, the policyholder, or if you're an agent trying to set policies up for maximum cash value for your clients, you can choose where your money goes. Those two areas, the base premium or the PUA component. A question we often receive is this: how do I put all of my payment toward the PUA rider because that builds cash value? And Steve, I don't really care about the death benefit, so can I put 0 toward the base premium? And the answer on that is unfortunately no. The reason why, so it goes to building awareness. We can choose where our money goes, but there are limits to be aware of. So 2 limits particularly that I want to be aware of are as follows. I have the insurance company limitations. All insurance companies have different limitations. You'll find with the top insurance companies, your 4 major mutuals, Mass Mutual, Guardian, New York Life, Northwestern Mutual. Typically, wherever I set my minimum premium, I can 10x that payment, that premium, as far as a total payment. So for example, if I had a $10,000 base premium, the company may allow me to make a total payment of $100,000 per year, that would allow for another $90,000 per year to go toward the PUA component. This is also flexible. Some years I can add money here, other years I cannot. I can choose to bounce those payments up and down. So I'm not committed to a big bill in that respect. So I've got the insurance company limit. They're not all 10x. That's more of a general rule or an average you'll see with the top companies. And the second limit has to do with the IRS. So what is the last core benefit of a whole life insurance policy in respect to the cash value? Tax-free. This is why so many people are attracted to it. So with that IRS limit, any life insurance policy can become classified as this MEC, which stands for Modified Endowment Contract. If my life insurance policy becomes classified as a Modified Endowment Contract, or a MEC, my cash value still grows tax deferred, but anytime I go to access my money, I have to deal with ordinary income tax on the gains, and if I'm under the age of 59 and a half, I have a 10% penalty tax. It's ugly, I don't want it, strips the policy of a lot of the attractive benefits. So every policy has what is called a MEC limit, which is exactly what it sounds like. It is a limit set by the IRS that determines how much money I can pay into the policy per year, my total payment, and still have the IRS view the life insurance policy as life insurance and reap the same tax benefits, not a modified endowment contract, and then assess taxes to the cash value. So here's the fun part about this. With the MEC limit, you, the policyholder, or the agent designing the policy, has control over setting this limit up front. What you will find is that it has a direct relationship to an individual's age and total death benefit. That is, call it the measuring stick that the IRS uses to determine if a life insurance policy will be viewed as life insurance in their eyes or a pure taxable investment. If it is classified as life insurance, that's where we, as the policyholder, can reap the tax benefits. So, steps to maximize the cash value on a policy. Minimize the premium, maximize the PUA. We also want to set that MEC limit at the appropriate number. For example, if I'm paying in $100,000 per year, I would want at least a $100,000 MEC limit and then a minimum premium based on the insurance company limits of about $10,000. To use this example, so we have a total of $20,000 going into this policy here, $10,000 toward the premium, $10,000 toward the PUA. Of the premium payment, nothing shows up in cash value right off the bat. So if this is you and you're paying in $20,000 per year, what would you want to adjust on this policy in order to minimize your expenses and maximize the cash value? The insurance company allows you to do what? Wherever you set that minimum premium, they will allow you to 10x that as far as a total payment per year. So what we want to do is as follows. Redesign or adjust the policy to reflect a $2,000 minimum premium, an $18,000 PUA payment, which is optional. So what I really like about this makes it very flexible where I can commit to this and then have the ability to add funds up to another $18,000, not committed to, but at my discretion, I can add up to $18,000 for a total of $20,000 per year. If I wanted the ability to go up to $100,000 per year, then I would want to set that minimum premium at $10,000 per year. 10% of my desired maximum. That's a good way to think about it. Let's look at some numbers to demonstrate this. We'll start with this example right here, the total of $20,000. First, we'll look at a policy that has a 100% insurance expense, 100% premium. So on the left, this is the same insurance company, same individual, by the way, traditional whole life, 100% base premium. Of his payment, base premium, $20,000, total payment, $20,000. Nothing directed toward the PUA component. We tallied up his payments here to really track the break-even point. So here, he's paying in $20,000 per year, and by year 14, he's paid in $280,000 total and he has $287,000. That is a long time to break even. But if we really focus on the early years, years 1 and 2, what happens with that base premium? We paid in $20,000. Right off the bat, I see 0 in cash value. Year 2, I see a little bit show up as a result of the company's dividend rate. But really, if my goal is maximum cash value, I've paid in $40,000 and I have $3,000 to show for it. 14 years just to break even and start to see a positive cash value. Not that attractive if my goal is maximum cash value. Now, if I look at the example on the right, minimum premium, maximum cash value, maximum PUA, $2,000 minimum premium, $18,000 PUA component, total out of pocket $20,000. Look at the difference here. $17,000 in cash value immediately. The death benefits initial level initially, the reason why is we did attach a term insurance rider to this. That has to do with that MEC treatment to make sure the policy remains tax-free. We've got plenty of other content on that. But what do we see here? $20,000 per year, world of difference. By year 4 now, I've paid in a total of $80,000 and I have just about that, $79,800. By year 5, I've paid in a total of $100,000 and I have over $100,000. Same company, same crediting rate applied, everything is the same here except for the policy design. Here, we minimized expenses, which hand in hand minimizes commissions as low as we can push them and maximizes consumer value. Now all of a sudden, as we look at the year 15 difference, here we had $323. Over here, you've got $418, almost $419. Huge difference there, especially as we look at it long term. You'll notice he only paid into it for 15 years as well. With a whole life insurance policy, do we have to make payments our whole life? No. We can fund for our whole life, 15 years, 5 years, adjust as we go, very flexible. There's a $20,000 sample. Here's a $100,000 sample. Same thing in respect to 40-year-old male, same company, same product, different design, meaning where's the money going? This one's a bit more simplified, as we didn't break down the premium columns and everything, but it's all the same. $100,000, all premium, a little bit of cash right off the bat. This product only overcharges in the first year. This is why year 2, I pay in $100, starts to come back, but still takes between 10 and 11 years just to get my money back. I paid in $1 million. By year 11, I have $1 million. Now, as I look at the same company, identical product on the right, just redirecting where his money's going, 100 goes in, 88% right off the bat. Breaking even between years 3 and 4. We have the annual internal rate of return, which is the net growth we see year over year. So we isolate each year, that's not the average IRR. But as we compare these policies, if we look at year 10 alone, and this is the part that will always fascinate me, even though I know every detail about it, I just thoroughly enjoy it, where same company product, out of pocket for the consumer, $100,000 per year for 10 years, how much more value were you able to generate by means of adjusting that design? Significant, about $240,000 over a 10-year span just by tweaking that design to maximize the cash value for the consumer. So overall, that is exactly how we will maximize the cash value for a consumer. If you have any questions or like information, feel free to reach out anytime if you are looking for a policy or if you're in the business trying to create policies like this for your clients. We're always happy to help, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.